So today we're going to be talking about the Magnificent Seven, AI, the recent correction. It's come back up a little bit, but yesterday it was a correction for the NASDAQ, and more importantly, what you can do about it. So even though NASDAQ is slightly recovered, it was down 10% yesterday. Today, which is July 30th, it's actually only down 8%, so it's not technically in a correction anymore. However, Meta and Tesla are both down a third, so 30% or more. That's just since their highs in June. SpaceX is down 50%. So we're going to talk about AI and what's the deal, right? If we're all using AI, we know that it's hot. Why is Wall Street killing the stocks? And as importantly, how can we add performance to our portfolio while also protecting ourselves from the volatility? There are easy ways that we can do this. So we're going to be talking about not only what the challenges are, but the solutions as well. So the first thing I want to show you are a couple of things. I had sent out this blog, Capture Gains at an All-Time High. This was sent on May 17th. The all-time high for the NASDAQ and for the S&P 500 was like June 1st and 2nd. So when I'm sending out these emails or posting it online, take it seriously because there's a reason for it. Now, actually, if you are rebalancing your plan, your wealth plan, at least once a year, you are capturing gains very close to the all-time high. We are strongly encouraging 3 times a year, not more than that. You don't want to be bobbing up and down or trying to, it's a bit like lifting a lid all the time and trying to get water to boil. You're more likely not to achieve what you wish to achieve, but once, twice, or 3 times a year at these strategic times that we always are letting you know, it's not any surprise, the end of the spring rally, the end of the Santa rally. And you could even think about doing it at the end of September, which is the worst performing month of the year. So again, we are trying, well, not just trying, we are keeping you informed and we are prompting you to do what you should be doing, which is that age appropriate, properly diversified plan. It's easy as a pie chart. I'll show you one in just a moment. And rebalancing is really key because honestly, if you've done it then in the, that May prompt or anywhere close to it, you would be sitting pretty instead of feeling a little bit more like an accordion. The other thing that I want to talk about, and I'm going to show you on our on my performance chart here, is that it's just a better idea for most people, unless you're as good at picking stocks as Warren Buffett, to try to hold these in funds. So you can see here that the Tech B fund since its more recent high, it's only down about 6.4%, right? And it's sure it hasn't soared as high as the other things, but it's done very well on Wall Street. Definitely outperformed the S&P 500. This is the performance year to date. So that's just a good idea because you can see here that Meta and Tesla and SpaceX are really underperforming from their most recent highs, but not just there, right? Like the year-to-date performance is down pretty bad as well. 6 out of 7 of the Magnificent Seven are performing below the S&P 500. The only one that's performing above it is Apple. They do a lot of stock buybacks of their own stock. So, I think that the real story here is, yeah, you do want to have AI, but even if you think something is super hot, like, we were warning in our SpaceX blog, which we posted before it started publicly trading, it's a hot company. It's doing exciting things. It's the leader in its industry. It's just overvalued. And that is the problem is that, a lot of the insiders are going to want to take their profits while Main Street and retail investors are buying high. So that's why it's very important to be cognizant of, these kinds of things, not just is it hot, but am I buying it at a good price, right? And again, most people are going to be better off holding SpaceX in one of the funds that it's in, rather than trying to, beat Wall Street's best, finest hedge funds with what they're going to be trying to do at your expense. Another thing I want to talk about is what is prompting all this volatility. So there are a few things that are causing volatility. And we saw it also in 2022. And one of the things is that when prices get so elevated, the ones that fly the highest are the ones that really crash the farthest. So let's take a look at the 2022 performance here. And what you're seeing is that the S&P 500 was down almost 20%, which would have made it a bear. It just barely above that, right? But Apple was worst performer. Amazon, not as, Amazon was down by 50%, Alphabet down 38%, Nvidia down 50%, Microsoft down 29%, Meta down 64%, and Tesla down 65%, right? So it isn't that those are the worst companies on Wall Street. It was that they were the most expensive companies on Wall Street. So that's another reason why, again, it's not that you don't want to have them, because if you decided that, oh my goodness, look at those, they lost so much in 2022 and you didn't hold them in 2023 to 2025, you were missing out on most of the gains because it really was the Magnificent Seven. That's why you're hearing about them. And that's why you even know the term Magnificent Seven, is they've been driving the gains on Wall Street from 2023 to 2025. It's 2026 where we're paying the piper, has a lot to do with valuation. The other thing that's happening is margin trading. So let me show you a couple of things. And one of them is another blog that I had posted on that when I said Wall Street has a serious gambling problem. So margin trading is literally at an all-time high. And as you can see here, whenever the margin debt to GDP ratios get very elevated, it's right before we have pretty bad downturns, right? The only reason we didn't have an exceptionally bad downturn in the pandemic is we printed up, $4 or $5 trillion to buy our way out of it. But the .com, the NASDAQ lost 78% of its value. The NASDAQ Composite Index took 15 years to come back. The Great Recession, the Dow dropped 55%, took about 5.5 years to come back. And by the way, these aren't nebulous terms. If you had $1 million invested in NASDAQ stocks in the dot-com recession, and you lost 78%, $1 million goes to $220,000. And then you have to wait, 15 years for that to come back. That impacts everything in your life. Same thing in the Great Recession. Not only did people lose 55% in the Dow, that stocks that they had, that might have cost them their home. We saw, over 10 million people lost their home. So these are not just like, oh, it's okay, I can afford to buy and hold and then come back. What we're seeing in the 21st century is these really very steep and volatility. And it has a lot to do with margin trading and also these very, very elevated valuations. Now, this time around, even more so, it's combined with debt, really debt that we haven't seen. So here's the excessive valuations. This was from earlier this month, but as you can see, the only time in history when stock prices were expensive as they are today was in 2000, and that's when the NASDAQ lost 78%. This is higher than it was in the Great Depression in 1929. And the other thing I wanted to show you here is that we also are dealing with very elevated debt. You hear all the time about the 40 trillion, almost 40 trillion in public debt. You don't hear that it's almost 116 trillion in total debt and loans, or that of all of the debt outstanding, about half of it is at the lowest rung of investment grade. So that means there's a lot of credit risk. And that is why, we have been navigating very carefully in the safe side too, because you don't want to have paper losses. They can become real. They limit your access to your money. They reduce your net value, your debt to equity ratio, your personal, debt to asset ratio goes down. Your FICO score goes down as a result of that. So we're very proud that, since 1999, we've been able to navigate this very carefully and help you to earn that competitive yield without the paper losses. So How do we do that? What are the solutions? I would say right now, you want to make sure that you have rebalanced recently. How do you do that? You do need to know what a sample pie chart, personalized according to your age, looks like. And you also need to know what you own and what that looks like if you put it into those categories rather than 18 pages of holdings. Sometimes I'll do an unbiased second opinion. Someone has 18 pages of holdings, sometimes even 4 or 5 accounts, and they think that they're diversified. And what they really have is just a boatload of large cap value and maybe a target date retirement fund, which is really not, they say they're very well diversified, but what they're doing is throwing everything in the kitchen sink in there. So you can't ever see and capture gains. And a lot of times they're throwing in things that we are severely underweighting. We don't want to have a piece of long-term bonds. We're not interested in dividend and income in the US when we can go and get other countries that have lower debt to GDP ratios, higher growth, and higher performance. So in both the income side and sometimes even the equity side. So our Peru fund, which is a value replacement fund, that one has really performed extremely well. Let me show you on back on our performance chart. And also you'll be able to access some of this information in the hot countries. Again, I'll link to all these for you guys as well in the YouTube description. But as you can see here, the Peru fund has really been one of the top performers. I mean, look at that in 2025. The only thing that was hotter than Peru, and again, instead, Peru is a copper play, but we thought that Peru would do better than just the price of copper. That's why we chose that. But the only thing that did better last year was silver. So again, in a properly diversified plan, you are going to have whatever you think is hot there. And our financial freedom retreats, we reevaluate what we think is hot. So, in 2024, I thought that Bitcoin was hot. In 2025, not as much, definitely not in 2026. Probably won't heat up again until summer of 2027. There are reasons for that. Might actually go even lower in between now and then. So every year, what's hot and what's safe does change. So this may start sounding complicated because I'm saying rebalance, get hot, know what's safe, have value replacements. And for some people, you want to learn this. It's the life math that we all should have received in high school. And then you can start learning how to self-direct your portfolio. You're only going to need 10 funds. You don't need 18 pages of holdings. You just need to rebalance it once, twice, or 3 times a year. Training with me, whether you do it at the retreat or through private coaching, you'll be able to get there on this. If you have never done this before, then it is a good idea, while stocks are still very close to their all-time highs, to know what you own and to know how well diversified you are. So here's a sample pie chart for a 30-year-old. Obviously, if you're older, it's going to be different. But basically, keep a percent equal to your age safe. Decide whether or not you need to overweight safe, and then have 10 funds, small, medium, large, value and growth, and then 4 HOTS. And this is really going to help you get far more diversified than those 18 pages of holdings that a lot of people have in a managed plan, where they're also getting charged 1.5% on average per year, right? So that's $15,000 per million per year. And attending one of our retreats or getting my private coaching to help you learn how to do this yourself is going to be probably look, our time proven strategies have outperformed managed plans, far outperformed managed plans. And it's a lot less money. So I would just say that now is the time to be the boss, to know what you own, to make sure that you have rebalanced, even though some of these AI stocks have taken a hit, if they are in your large cap growth fund or your large cap value fund, they still might be very close to an all-time high. We'll do a quick spot check. So one of the large cap growth funds that we like, which was highly concentrated in the Magnificent Seven, is IWY. And as you can see here, if we look at the max, it's still trading very close to its all-time high. If you look at it in the 5-year plan, it is. Now, if you look at it year to date, it's going to look a little bit different, but not terrible, right? So again, that rebalance, and if you didn't have this, then you were performing at half the speed of the S&P 500. So I'll go ahead and stop it here and see if anybody has any questions that I might answer. Okay, it was a really good question. So this person said, "Hey, can you just give us an example of someone who's more like 50?" So that also gives me an opportunity to show you how you can even personalize your own pie chart. So let's do it. Here's the free web app. It's super simple, it's super rudimentary, but you can use this. So basically, we'll start off with sorry, hang on, your age. Let's say this person is 50. Now, whether or not you want to overweight safe, you can change that. So I'm going to take it off for now so you can just see what an age appropriate plan looks like. Let's say this person is making $100,000 a year. Maybe they work in Silicon Valley. And that means they're going to deposit 10% of 100,000 into their tax protected retirement accounts. That's a big piece of it. And by the way, I do have wealth, tens, wealth tips that are in the blog. We also have a wealth secrets of the 1% that you can have access to if you register for the Financial Freedom Retreat. Let's say this person has $490,000 in their 401ks, IRAs, etc., health savings account. So here's what it would look like. And I'll make it a little bigger. So basically, you always want to keep a percent equal to your age safe. So a person who's the age 50 has half of their $500,000 nest egg safe. Now, the nest egg, I'm going to take you back because when you're putting in how much your liquid assets are, you want to have, it's an aggregate. It's not just what you have in your 401k or RSP. It's also any individual retirement accounts that you have. It's what you have in your checking account. Do you have an annuity? Do you have any private equity or private credit? Do you have any savings account? Do you have a health savings account? So it's an aggregate of all of those. You don't put the equity in your home because that's your hard asset. So it's all your liquid paper money that you're going to be putting in there. So the stuff you have in cash is if it's FDIC insured, it's kind of already on the safe side. Maybe that's your checking or your savings, right? And then the stuff that you have in your 401k, you might have some in there that's in, short-term treasury bonds or something like that that's pretty safe, that's earning about 4%. So what we really are going to want to do is take a look at all of those holdings. I use an Excel file so that I'm looking at a holdings pie chart that's similar to the sample pie chart, right? So this person should have about 25,000 per slice in 10 different funds. Now, if we take a look at your 401k and your IRAs and all of this, and you have, $100,000 slice, and that should be 25,000, you sell high. If you have never invested in things that you think might be hot, we might dollar cost average into them, and so that you don't just buy pretty close to the all-time high. So there's certain little nuances that we can do, but this pie chart system, when you mock up what you should have and mock up what you do have, it makes it easy because the slice is too big, it's telling you sell high. The slice is too small, it's saying buy low, right? And then also it's helping to take the emotions out of it because a lot of times people are saying, "Oh, but I like this," or "Oh, but and I'm saying, even if you like it, you should capture gains, at least once a year because of the volatility of the market or because stocks are very expensive. So, and also all of the other things that add to the levels of risk that we talked about. So I'm also going to take this opportunity to just show you, again, you can get your own access to this pie chart and personalize it yourself. If you think that you're worried about all the levels of debt, the margin trading, the elevated equity prices, you can, add some safety. Basically, you're pretending you're older than you are, right? So instead of having 50% safe, you could have 70% safe. And then your slices of what you have at risk goes down. It's only 150,000, 15,000 per slice of your $500,000 nest egg. And then you want to make sure that this 350,000 is earning at least 4% without paper losses. And that's easy to do. It's tricky, but it's not difficult. So, and that's important, right? Because 4% of $1 million is $40,000 per year. That's a really good extra bonus income for us. So we want to make sure that our safe side is earning income safely, and our at-risk side, where the performance really can be, is properly diversified, and we are able to capture gains regularly so that we keep that age-appropriate, properly diversified plan in place. The hot slices actually sometimes limit us, right? So if you're just like super into gold or silver or crypto or whatever, instead of betting the farm on it, have a hot slice or two, and it's still going to help you to keep you on the right side of the trade. So let me show you also. So again, info@nataliepace.com if you want access to that. But let me show you also our homepage. So this is nataliepace.com. If you're interested in the Financial Freedom Retreat, you should register by tomorrow. And the reason is that you're going to save money because our early bird pricing ends tomorrow. If you want to bring someone with you, the second person will come at half price. So it's a really good idea to check it out. And if you ask the person that's registering you at info@nataliepace.com, we can give you access to the recording of my Wealth Secrets of the 1% masterclass. I'm happy to do that. Let me show you a couple of other things that are here because some of them are free. These are wealth mantras that help us to always be thinking about the thing. They're based on the wealth secrets of the 1% too. And that's free. That's a free video coaching program. If you click on it, it's 21 days, do 1 day video conference per day. In the morning, it's only usually 5 to 10 minutes. And then you think of that mantra all day long, but it also tells you ways that you apply it, right? So there are various things here that you can do. There's my links to my books, links to the Instagram and what we're posting there. I would suggest that you are following me on Instagram and all the social media that you're on, because I can't email you every day. You're going to get sick of it. And sometimes your email, your ISP is going to put my stuff in spam. But if you're checking my social media, then you're going to be aware of what it is that I'm trying to prompt you to do or warn you about. And that's going to be pretty important. So you can access all of the social media right at the top. There's the links to everything: Facebook, X, Instagram, LinkedIn, email, and even the podcast and YouTube. And then finally, if you are interested in sustainability and a grand adventure, we have 3 rooms at our Manor House retreat in Cornwall for March of 2027. And they're always come here for the links to the books, because as an example, I just released the 2nd edition of the ABCs of Money for College. So I will see you again. As always, I will be posting on Substack and YouTube at least once a month, but usually more frequently than that. My vlogs are every week. My retreats and masterclasses are every quarter, and I'm always available through my private coaching for an unbiased second opinion. And again, if you've not done this, then now is the perfect time to do it, because stocks are really high. I know we focus on the minutia and say, oh, we almost hit a correction yesterday, or we did hit a correction yesterday. It's back up out of the correction today in NASDAQ. But it's better, the sooner that you adopt an age-appropriate, properly diversified plan, and have a plan for adding some of those empty slices that you might be missing, the better it's going to be. Also, knowing what's safe in a debt world is very tricky, because a lot of the managed plans that I look at are suffering from paper losses. And a lot of the individuals I've been putting into long-term risky bonds. I've seen 85-year junk bonds that people are put into that have immediately lost money on their principal. And then, of course, they try to placate them with their only paper losses. But if you have an 85-year bond and you're 50 years old, you're not going to live that long. So really important to be the boss of your money and to know what you own and not just have blind faith that somebody else is protecting you because I am seeing a lot of shenanigans. There are investment banks and brokerages held in the same bank. And there's a lot of pressure when the investment bank is going to raise money for a corporation for the brokerage side to sell those bonds. So, I just think that it's really important to be the boss of your money and to learn the life math that we all should have received in high school. And we have done everything in our power to make it as easy as a pie chart and to educate you so that you can actually self-direct quite easily. You can still hire someone to do it for you, but you need to still be the boss. It's just like building a house, right? It's important for you to know how many bedrooms, whether or not you're going to be able to walk upstairs, if it's going to be a city rat or a country mouse, whatever it is, it's what you're living in. And the same thing should hold true for your financial house, right? It should make sense to you. It should not be something where, you lose so much that you're suffering health ramifications from this, as well as fiscal health ramifications from this. So, yeah, we want to put you in a financial home that can survive economic storms, where you can capture gains, where you can earn income safely without paper losses. And it's not difficult, it's just tricky. So thanks again. Natalie Pace on Substack and YouTube, and nataliepace.com, info@nataliepace.com if you would like to email us. And this is free, so please send it to your friends. Thanks again.
Fools are making history in this murder in the name of peace. You gotta slow this dance, I'm begging you. Who was that man on the evening news? Does he leave behind a family with hearts of stone, with eyes of steel? Peace on earth, like a